Sid, I'm super excited for this conversation. I think it's been a while in the coming since we did our panel. So maybe we can just start with a introduction on you and people and like how this thing came about.
Maple today is an institutional lender.
Yeah.
Where I began was in banking, and so I was kind of always doing lending.
You're the guy with the big phone.
Yeah, I'm the douchebag walking down the street with a big phone.
Private lending markets is somewhere in the like 1.5 to
1.5 trillion.
Yeah.
Yeah.
In the trillions, right?
Pretty soon everyone will get rid of their fiat bank account. Very soon I won't have any fiat and I'll just use stables. As soon as I can pay for a debit card with stable, Apple Pay with stable. One of the problems I have with the crypto space is that we are presumed to be illegal until we are deemed legal by granting a law to say that you can use and operate and move around crypto.
Cool. Sid, I'm super excited for this conversation. I think it's been a while in the coming since we did our panel with Natalia from Proppy. And I just really love what you guys are doing and the kind of genuine use case and adoption of that. So just wanted to dig in and really learn more about you and Maple and just really excited for this one. So
Me too. Let's do it.
let's do this. Cool. So maybe we can just start with a introduction on you and Maple and like how this thing came about.
Yeah. So zooming out, where I began was in banking, and so I was kind of always doing lending, and then I went from banking to a lending company. So when I was in banking, just to frame it properly, I was working with lending companies, and so typically we would have pretty entrepreneurial clients, and they would build lending businesses, but borrow from a big bank, and then they would sell, effectively sell bonds to investors. So that was it's very similar to what we're doing now at Maple, except we're more on the lending company side of things. And so what I did after banking was I transitioned across, went to a smaller lender and ran their treasury for a while. And that was where I met my co-founder. And we were thinking, the initial idea was, could you do bonds on chain, similar to what I've been doing in banking and similar to what we were doing at that lending company. And it was very early. It was kind of the start or the genesis of DeFi at that stage. This was mid 2018. And then as we started to learn more about the space, we tried to evolve this idea. And eventually what Maple became today is now it's like an institutional lending company. And we had to move beyond this idea of just tokenizing bonds because there were no assets that you could, use to generate the yield for the bonds at the time that we started. And so we just had to kind of always evolve and overcome the hurdles that we were coming up with, which included no yield bearing assets on chain to then not being able to do retail borrowers on chain. And so, but I think it's very easy to say, we were trying to solve a problem when we started Maple, and we kind of were, because we identified there was a gap, which was, there's this brilliant new technology, which is smart contracts, and you can have programmable loans. It seemed obvious that you were going to build really, really big lending businesses off of that. But that was really what we wanted to do, which was we wanted to have an impact on the finance sector by building a lending company that could become really, really large. And so we just happened to find this great new technology that we could do that with. And so that was kind of the initial idea and how it evolved.
Well, I mean, you say it sounds obvious. I mean, it's obvious now. At the time, if you asked that to like general people,
they would have said we were totally nuts.
They would have said you're nuts, right? But I guess you had that kind of deep domain expertise plus that curiosity on the blockchain side, and you kind of tied the two together. Was there like a light bulb moment for you? Because I remember for me with Transact, there was like a moment where I was like lying in bed and I couldn't sleep, and I just thought of it. Was there like an actual like instantaneous moment where you were like, I'm doing this, or was it kind of more of like a process over like?
It was more of a process. There's with any good idea or idea that pans out, there's an initial moment where you're really excited about it. And then you're euphoric. You think it's great. You think it's gonna revolutionize the world. And then as you dig deeper into it, you discover all of these ways in which it could go wrong, or which it's
Yeah.
going to be really difficult to set up. And then you go through the trough of disillusionment.
Yeah.
And we're pretty quick to get to the euphoric moment where we're like, okay, bonds on chain is obviously going to be huge. Tokenizing bonds is going to be huge. You can kind of see it as now, and it's starting to get that way.
I know that seems obvious to you and maybe to me a little bit, but like at the time, what was that euphoria based on? What did you visualize that would be so powerful about that?
That's a good question, and this is going to seem very in the weeds to somebody who's not in finance. So try and simplify it. But
let's get daddy on finance.
When I was in banking, we would do securitization. This meant you would have a bunch of different tranches of bonds. So you'd have something that's very senior, call it an A grade bond, and you have a B grade, and what they mean is you're getting paid more interest as you get to the lower grades, but you're also taking more risk of default.
Yeah.
This is a lot of the stuff that happened during the GFC. But the brilliant insight was that if you had a smart contract, why couldn't you program 100, 200, 300 tranches of bonds? Right. Because it's very easy to replicate with software. It's very hard to replicate with paperwork, Excel spreadsheet models. And so the idea, the light bulb moment was that you could actually have an infinite number of tranches where effectively every dollar could be a separate tranche, or every $100 could be a separate tranche.
Yes.
The way it works now is you might have $100 million as one tranche, $50 million is the next tranche, and so on and so forth.
Right.
And so it was the mental representation of doing that was the light bulb moment.
And are we talking about debt, like private debt in companies here specifically?
This would have been home loans. So you can do private debt in companies, but for the most part, most of that market is tens of thousands of home loans, car loans, credit card loans.
Okay. And that's loans like mortgages, right? Like
mortgages. Yeah.
Okay.
So securitization gets a bad rap because of the GFC, the Big Short, but mostly it's the technology that works every day, financial technology, to get you a really low rate on your home loan and allow many more people to own homes than would be possible if it were only banks doing this, and if you didn't have insurance funds, asset managers, pension funds, endowments, all investing in people's mortgages via these bonds. Because what they do is they lower the risk.
Yeah. Okay, so we've got different types of loans and bonds that are either kind of like private debt or mortgages or loans that are collateralized on something else.
Yes.
And then you've got different levels of seniority on those debt instruments, like something that would liquidate before the other, or something that's more risky than the other, right?
That's right.
And then you've either got floating rate or fixed rate of interest on that, right?
Yeah.
So and then you've got different ways to slice that and dice that, and what you're saying is because of the limitations of the traditional finance system, you weren't able to slice it and dice it in as perfect a way as you could visualize at that moment when you were starting this company.
That's the aspect that kind of initially pushed us into it. But it's fair to say that I think if you described that and said this is the benefit of what we're doing today, it would be fairly abstract for a lot of people.
Right.
Nowadays, what Maple's doing is actually a lot simpler. It's more like, here's a company that wants to borrow $10 million for, OPEX or for expansion, so CapEx.
Yeah.
But they're using it for general business purposes, and we might have a pool that does 10 or 20 of these.
Yeah.
And so it's much simpler. We're not doing 10,000 home loans. But I think if one of the things we can talk about is where this gets to over 5 years, and eventually that will be the case.
Yeah.
And eventually it will translate to a lot of cost savings and lower interest rates and hopefully more home ownership for people, because you're able to do it in a much more automated way. So all of that slicing and dicing will happen automatically. Maybe AI will be doing it.
Yeah.
But that's the 5-year vision. Right now, the initial wedge is there are companies who want to borrow, who won't be served by banks.
Yeah.
And so we can carve out a niche helping them.
Yeah. So that's super cool. And I think like Jeff Bezos and other like famous entrepreneurs have said that you have to be like very stubborn about your vision, but you have to be flexible about how you get there, right?
That's right. I would say that accords pretty well with our journey, because initially, we didn't end up starting with tokenized bonds. We didn't start with anything close to that. But we did start with lending, so similar, similar flavor, just slightly different. And the end direction is the same, which is I do think all of capital markets will end up moving on chain and be, global. Interesting concept of serving the long tail of capital markets, so companies that are much smaller, otherwise today would have no chance of accessing capital markets because it really requires scale. And similar to what the internet did for online communities of aficionados, you can have smaller companies still find, debt or equity from the capital markets. In our case, debt. That's what we deal with.
Right. Okay. So when we were preparing for this, and like I think we've been speaking quite a bit over the last couple of months, and like the first time we were speaking about this, and I was like trying to do like a synopsis on Maple, and you were like, and I did some research on the internet, and you're like, no, we don't do that anymore. We don't do that anymore. So let's try to paint a current picture of like exactly what it is you guys do right now. What types of debt, what types of customers, and maybe like you can clarify some of the things that you don't do anymore.
Sure thing. So Maple today is an institutional lender.
Yeah.
We have multiple pools.
Yeah.
Each pool could be, the best way to describe it is something similar to non-bank lender or a credit fund, but not quite the same. It's not really structured that way. But let's just say you have these pools. Each pool runs a different strategy, doing commercial and institutional.
A non-bank lender is just
non-bank lender would be
with some money who wants to lend it and earn.
Yes. Yeah. Okay. So it'd be a company that's doing lending. Maybe they do a specialty like aircraft leasing.
Yeah.
So owning but leasing planes to airlines.
Yeah.
Or they could be doing something really basic. So just cash flow loans to middle market companies. When you say middle market companies, you mean a company with anywhere from 10 million EBITDA up to maybe 100 plus.
Okay.
But not publicly listed.
Yeah.
So Maple's doing institutional lending. We today do secured variety. We're looking again at the kind of the cash flow based lending, which would be also called unsecured lending. And then we do some real world asset lending. And of that, we have a pool that does loans collateralized by T-bills. So, you would have seen a lot of these real world asset T-bill products in 2023. And then we've got another one that does tax rebate finance. So tax receivables finance for small businesses in the US.
Okay.
So that one's, so the mix is crypto native lending, which I would say is going to be the focus for this year. Okay. And then you got some real world asset lending, which did very well during 2023.
Okay, so when you say crypto native lending, we're talking about uncollateralized loans.
Mixed. So you have there's uncollateralized lending and then there's collateralized lending. We actually do both.
Yeah.
Initially, what we used to do was uncollateralized lending or unsecured lending.
Yeah.
I think that got a bad rap in the space. But
why?
It got a bad rap because there were large borrowers who had actually in some cases under collateralized, still partially collateralized, but the notable ones would have been 3AC, Alameda, but then it's just a type of lending, right? And so all credit goes through cycles. In when you reach the top of the cycle and then things turn into a downtrend, then you'll expect to see more defaults. I think the problem in crypto during the last cycle was the level of concentration and the fact that there were a few very large borrowers that touched all of the lenders.
Okay. Yeah. Like my understanding of that is that like a lot of the stuff was just kind of knock-ons from like Terra Luna, and then all of those things were kind of like built on top of that. And
some of it, yes. Some of it that was a contributing factor, but not the entire factor. 3AC probably, had Terra Luna as a contributory factor, but they also had the market go against them in other trades.
Right.
Alameda, had different causes of their issues. I'm sure they lost some money on Terra Luna, but they're also losing money on other things, and they're also spending exorbitant amounts on, other investments.
Yeah, but they had a sick penthouse though.
They did. They had, which is often when you're looking at credit. They talk about competence, character. The character of the borrower is something that's considered.
So in that case, not so.
In that case, having a penthouse is often a warning sign, and the way that the borrower conducts themselves can be a warning sign.
Yeah.
However, if you look at SBF's case, he would also go to great lengths to point out how he didn't have a lot of the trappings of wealth. So he might have had a penthouse. You never really saw the penthouse on a lot of media and content that was produced. You did see that he drove a Corolla. Had a Toyota, didn't eat fancy stuff. Wore T-shirts, wore old Reeboks.
Yeah. So
but anyway, so I think crypto native lending broadly could be characterized as trading firms, funds.
Mm-hmm.
I think it could expand. It should really expand and encompass anyone who's doing a lot of business in stable coins.
Yeah.
And one of the things I'm interested in is could you expand that to discount finance for law firms, for security audit firms, for PR and marketing firms? That's a fairly standard form of traditional finance where somebody has an invoice that's going to get paid soon, and you effectively buy it off them at a discount.
Yeah. Okay, so you've got the you've got the mixed loans, and then you've got the real world asset collateralized loans. And what percentage of your business does each of those make up at the moment?
It's a good question. It's about 50-50
at
the moment. So we have about 25-ish million in the tax receivables pool. So that's real world assets. And then we've got another, call it, 25-ish in the cash management. So that's the tokenized T-bills.
Okay.
We've got 25 doing the over-collateralized loans. Yeah. And so what we've done there is we have loans against GBTC, BTC, staked ETH. So that's the over-collateralized business. And then we've got a $3.5 million uncollateralized loan to a to a very large diversified financial company in the space.
Okay.
And so if you look at the mix, one of the things we've done, which I think is really important, is we segregate each of those. So each of them is a separate SPV, so that if something goes wrong with the unsecured loan, it doesn't affect the secured loans.
Okay.
Doesn't affect the real world asset pools. And I think that was one of the issues learned from firms in 2022. Yeah. So, when you had an issue, it was all on a single balance sheet. So it's like you had, one pie, and if the pie got spoiled in one part, it spoiled the entire thing.
Yeah.
And so that helps manage risk. But the most of the growth has been on that crypto native sort of mixed side of the business. So that was 30 mil of new business that we did in Q4.
Yeah.
We actually just did a $9 million loan today.
Oh, cool. Congrats.
So this is, middle of January.
Yeah.
And we've probably got another 20 mil in the whip.
Okay.
So 20 mil in upcoming loans there is over the next 2 weeks, 2 or 3 weeks.
Nice.
So but that business, it's worth noting, you couldn't have done that business 2 years ago because you would have been competing with BlockFi, Celsius, Genesis, Voyager. There were a lot of businesses who had very heavy footprints in that space, and we would have been a tiny fish. So it would have been very hard to kind of muscle our way in.
And the rates of return were like insane.
Yeah.
On that, right? Like unsustainably so, but at the time they were like high.
Yeah, well, often, the deposit rates were often being financed out of equity. Not in all cases. Like some of those, some of those businesses were turning a profit consistently the entire time.
Yeah.
But what it highlighted was it was very tough to compete because you had to pay out very high rates to depositors, and it wasn't clear that you could earn more than that on the loans you're doing. But also, as with every credit cycle, irrespective of whether it's crypto, you see what happens is as you get to the top of the cycle, there's a decline in credit quality because it becomes a borrower's market. So borrower can say, well, if you're not going to lend to me, Maple, then I'm going to go to this firm over here and they're going to lend to me on looser terms or at a lower rate. And so it creates a race to the bottom. Right now, what we're at, we've gone through the bottom and now all the borrowers are coming back and going, I'll pay whatever you want. Just please give me a loan. And that's happening because prices are going up. So on unsecured lending at the moment, rates would be 15 to 20.
Yeah.
We've had people bid us at 15. We've had people bid at 20. And it's a lender's market. So we can say, well, we won't do you, or we'll give you a loan, but only up to this sort of amount. And this firm over here that's willing to pay 20, they'll get the loan first. So that's a lender's market.
Yeah.
In the other case, it was a borrower's market where many of us lenders would go to a borrower and they would say, well, this guy's giving me a loan at 7%. Will you give me 6.5%? And so tables have totally turned.
Yeah. So I've got a like an anecdote here that like Transact could be one of those people, right?
Yeah.
Because like just to kind of give a concrete example that might make it easier to understand, is that we as a company we sell crypto to people.
Yeah.
And we hold an inventory of that crypto. And a lot of the transactions we do are like card transactions, and those don't settle until the next working day.
Yes.
So let's say you've got like a Christmas or like a New Year's, it could potentially be like Friday and then like Monday, Tuesdays off. It could be potentially like 4 or 5 days.
That's right.
So we have an inventory problem where like we have to keep sending crypto to people, and then we don't get the actual money settled. So eventually, like, I mean, we've raised cash, we have cash in our bank, but eventually we're going to run out of liquid cash. And we have a receivable, so we know that money's coming in like a few days. It's not like we're not good for it or whatever. It's just that we need more capital, otherwise we just can't serve our customers.
Yeah.
So I guess that kind of answers the first part of the question of like, who are the people who are borrowing on your platform? Because like we could be one of them. So that's like super clear.
That's right. I find it a really interesting use case. And what
it's kind of like e-commerce even, right? Like if you're like selling something on e-commerce, you need some inventory. And then there's going to be some gap between when you buy that inventory and when you get the money received. But who are some of the other types of use cases of like who might borrow off Maple?
The use case you mentioned is really good, and it's similar to a Forex business or an e-commerce business where the problem is the customer sends the money, and you the issue that you articulated is that you don't get it for 4 days. And this is one of the issues with traditional finance is you often have these very delayed settlement periods, but you don't get it for 4 days, but the customer wants to use it right away. So there needs to be float for the customer for the intervening 4 days. And so that's where in that instance, a firm like Maple could front you the capital as a loan. And then we effectively are buying that receivable as a discount. So if you're expecting to get $100, maybe we give you $96 or $97 or $98. And then when the money comes, it comes straight to us. And that's invoice factoring or discount finance.
And how much of that are you doing at the moment? None. Okay.
None of that directly.
Okay.
The accrue pool, which does tax receivables, is very similar to that because that is a payable from the government, which is going to a small business, which is purchased at a discount.
Okay, but that's something like you probably will do in the future.
Yes, right? 100%. Crypto native business uses stable coins. It much lower risk because we're only warehousing the risk for a few days. So it's we give you a loan and then we get the money back 4 days later.
But we could just borrow money like outright. We could just have like a fixed.
Rate you can structure it any number of ways. So what I mentioned was invoice factoring or discounting, which was really common. Then there could be a term loan where we just give you a loan for
like 6 months.
6 months. You could have a revolver, which is where we give you a line of credit and we charge you a fee when it's undrawn. But then when you draw it down, you just you can take it down whenever you want, but you don't pay interest when you don't need it. And so there's any number of ways to kind of structure this. Debt is not. Debt's more complex than one product, and I think often people just think debt is just giving out loans like that. But there's many different ways to kind of share the shape. Other companies though, so we've done funds. So for a fund, the fund might want to delay a capital call. So for anyone who's listening who's not familiar with how funds work, if I go and raise the Maple Venture Fund of 100 mil. What I would do is I would tell people, okay, 100 mil, but it's 4 capital calls. The first one is now, so that's 25 mil. And then in next quarter, I'll come and ask you for another 25. And then 6 months after that, I'll ask you for another 25. What that fund could do is
because you're not going to deploy it all immediately.
But what happens is if you take in the 25 mil and then you sit on it for 6 months, it's not doing anything.
Right.
So it's not earning your LPs good returns.
Idle capital.
And so what a fund could do is it can actually borrow. So that fund could borrow a 25 mil loan off of us,
Yeah.
collateralize it with, let's say the first 25 mil they bought BTC.
Yeah.
So they could collateralize it. They can also say, well, you can see that we have this 75 mil in capital calls coming in.
Yeah.
Our investors are good for it. But we don't. We want to wait another month or two before we ask them, and we want to do some deals in the meantime.
Yeah.
So it makes the returns of the fund look better. The investors don't have to put down money now, so they don't have to cough up 25 mil now. They can wait another 2 months.
Yeah.
And we get paid interest on it, and we can we consider that's a fairly good credit. It's the fund pledges a bunch of assets to us. We know they have a bunch of investors who are putting in money, and the asset manager might have $500 to $1 billion of assets under management.
Yeah.
Traditional finance does loans like that all the time. Typically, they are, done by banks.
Mm-hmm.
Maybe some of the larger credit funds, but it's a fairly tough market to get into. But in crypto, because no large banks will touch crypto and no large credit funds will touch crypto, there's all these products that you can kind of create quite good risk-adjusted returns and quite good lending products. And if we were in traditional finance, we would have to specialize on one little aspect. But you can see we've already talked about a term loan, talked about invoice factoring, we've talked about NAV loans to funds. We can kind of do a real mixed bag and pick and choose our spots. And we have to be flexible there because there's not enough business to specialize in one only.
Yeah. I'm just laughing at that because I've had some really fun conversations where I've gone to speak with someone in insert the blank big bank and discussed about doing something with crypto and blockchain together.
Yeah.
And they didn't necessarily know that I was crypto focused before the meeting. And then the look of
horror, abject horror. You could have told them you're involved in gambling.
It's I was having a nice day.
Yeah.
And this has just ruined it.
Yeah. You could have told them you're involved in gambling. Any number of other things, and they still would have been able to serve you. But when you say you're involved in sending money over the internet, it doesn't pass the risk bar.
So the types of people who are lending could be people like us, could be forex, e-commerce, basically anything where you're having to send cash or goods to someone and you don't get the cash until sometime later. You've got funds who are borrowing because they're not deploying the capital instantly. What are some of the types of lenders who are coming? So they're not banks. We know that. Yeah.
And it's worth noting. I'll touch on it in a second, but it's worth noting that debt is in every business. So in every business, you either have equity or you have debt.
Right.
And even the shopkeeper, the grocery store owner who takes delivery of a bunch of bananas and produce and pays for it 30 days later, that's a form of loan. That's a 30-day loan because they're not paying for it instantly.
Right. Interesting. Yeah.
And so that, that's just, it's everywhere. Once you start seeing it, you see finance opportunities everywhere.
Yeah.
The types of lenders that we have at the moment, it's as with any new market, it's predominantly taken up by high net worths. So you have a lot of high net worths in crypto who might have made their money from being early Bitcoin holders, ETH, other cryptocurrency. And since they've made most of their money now, they are interested in asset protection. So it'd be like an entrepreneur who had a successful exit, and then suddenly they have a banker, and the banker's now saying, okay, well, what we want to do is diversify your risk. So we want to have some in credit, some in equities, some in appreciating coins, some in venture. And the bucket that we fill is, okay, you want some yield. So you want downside protection and you want to get income. And so they love the product. They prefer the higher yield stuff at the moment. So 2023, a lot of them wanted the tokenized T-bills because they could stay in stables, they could self-custody their funds, and they could get it back next day. They then migrated to things like the tax receivables pool because that was paying about 14%. So that's a pretty good interest rate, and that was net of all fees.
Yeah,
and it was quite well diversified, and so in addition to them, we've also had foundations. So a foundation might want to get 7, 8, 9%, and their goal is to maximize their treasury so that they can continue promoting an ecosystem. So it might be an L1 foundation,
Right. Okay.
and
Like an L1 or like okay.
so you got like an L1.
Anything
So
that has a decentralized network, like
the-
maybe like a Filecoin or like a
yes, potentially. So it could be
Yeah.
a Filecoin, an Algorand, a
Yeah.
Cardano, Hedera.
and they have some
um,
foundation with some funds that they
But
want to
yeah, typically all of these L1s have a similar foundation model. So you have your labs entity, which is developing the tech, and then you have
Yeah.
the foundation entity, which is kind of the balance sheet.
and they have a lot of cash, right?
Yeah, they have a lot of cash and they have a lot of
Hundreds
tokens.
millions or billions.
And so one of the treasury issues they run into is that they might have billions of dollars, but in a token.
Yeah.
So let's say I create an L1 tomorrow,
Yeah.
and I have I mint like $1 billion worth of tokens.
Yeah.
Well, I still have to pay. I can pay my staff in some tokens.
Yeah.
But I also have to have dollars. Like I can't pay my legal bills in tokens. I have to pay them in dollars.
Yeah. Yeah.
And so they end up with a treasury issue. And so if I had $1 billion, I've got to get some of it into cash. Uniswap's DAO faced this issue because they ended
Okay.
up with a ton of uni tokens, but then
Yeah.
they had to pay for grants, they have to pay for staff, they have to pay for legal bills, and so that's where, in addition to to diversifying into stables, they might then want to get a yield on those stables.
Yeah.
Because if you go into $100 million, you're not going to spend that all at once, and so you want to maximize your interest income within a risk adjusted.
That's a
appetite.
That's a lot of money as well. I mean, if you think
There's
about
billions across
all
all
the
of those foundations.
Yeah. Probably like hundreds of billions.
And a lot of them will have maybe a CFO or a treasurer who will manage that internally, but they also, in a lot of cases, will delegate to other managers. So a foundation becomes kind of like a fund of funds, but with one client.
Yeah.
And they will park some in venture, they'll park some in yield funds, they'll park some in hedge funds. And, the kind of the allocation we want to fit into is private credit. Private credit is booming in traditional finance. It's grown immensely. It's now about $1.5 trillion.
Yeah.
We want to fulfill that bracket in the crypto and the digital asset space. And then the other one which is less developed, is family offices.
Yeah.
So family offices and also token treasuries. So you might have a startup similar to us that might have raised a seed, seed or Series A, maybe sitting on 5 to 10 million, and they also want to maximize that runway. So maybe they put it into the T-bill pool that we have. Yeah. Get 5%.
Which is like most startups, right? I mean, we heavily utilize all the capital. We're like constantly turning it over.
Yeah.
But a lot of startups will just sit on that money, right?
Yeah. Well, most startups will die the death of running out of money.
Yeah.
And so,
but at the start, it'll be really nice.
At the start, it's really nice.
At the end, not so nice.
But
at the start, there'll be like a lot of like idle cash. And
but at the end, they will be thinking, that cash is oxygen, and they will be gasping for every last breath. So
if only I invested it in Maple Finance, and then I could have had an additional 3 months of runway, and my life wouldn't suck.
Which was different when T-bills were 0, but when T-bills are 5%,
significant.
If you had $10 million, you're getting 500,000.
Yeah.
So maybe you can pay for 2 or 3 developers. That's 2 or 3 extra developers a year you can have.
Assuming 5%.
just on your interest.
Yeah.
From T-bills. So, close to the risk-free rate.
Yeah. And I mean, that's just like good financial management, and that's it. Yeah. Advisable. Yeah. Okay, cool. But so it's mostly like crypto native lenders we're talking about. And it's really interesting because they want to have diversity, but they may not. Like, I know a lot of crypto native people who just don't want to take their stuff off chain. They just refuse to take it off chain.
Yeah. I hate banking. I'm one of those people. I have a bank account, like I have an overseas bank account in my home country, Australia. And if I were to move that through the banking wires, that would take me 3 days.
Yeah.
And there's a limit, so I have to do it in chunks.
Oh, that's so annoying.
And then I am getting, I'm getting rinsed on the fees because and I don't have another provider. So the bank is saying, well, if you want to switch to US dollars, we're going to set the exchange rate at what we want to charge.
Yeah.
And you can bet it's worse than what the open market exchange rate is.
Yeah.
And so the best bet, I can actually get my money into, loaded onto a debit card to spend overseas in less than a day if I go through a cryptocurrency exchange,
Yeah.
buy USDC, send it to a different wallet, send it, off ramp it via an exchange
Yeah.
overseas, and that's just a better product for me as somebody who spends a lot of time overseas,
Yeah.
who wants to manage my accounts. Now I prefer to hold most of my cash in USDC because it's easier to move around. I prefer being able to self custody it. There's less fees than paying international transaction fees. So yeah, I think the majority of people will go in that direction.
Yeah.
So I liken it to the early days of the mobile phone. You remember, in the 80s and 90s, there were a few executives who had mobile phones,
Right, the like
and
big ones.
yeah, they're the really big brick, and and everybody would see them and they would go, what a weirdo. And then later they got smaller. Everyone had one,
Yeah.
but they also had their landline, so you'd still have calls come through in the evening, and it'd be people who knew you.
Yeah.
And then as we progressed, the calls just steadily became telemarketing scams.
Yeah.
And eventually, you got rid of your landline. You just had a mobile. I don't know anyone who has a landline anymore.
Yeah.
And in the same way, I think stables will go that direction. Currently, I'm one of the people who has stables and fiat.
Interesting. Yeah.
I think very soon I won't have any fiat and I'll just use stables. As soon as I can pay for a debit card with stables, Apple Pay with stables, and then eventually I'll get rid of it. But then pretty soon everyone will get rid of their fiat bank account.
So you're the guy with the big phone.
I'm in that instance. I'm the I'm the douchebag walking down the street with a big phone.
But there's also like a network effect to that, right? Because like for example, in the UK, where I'm originally from, they rolled out like this chip and pin thing for paying with cards, and it took a while for like the merchants to adopt that, and it took a while for the consumers to adopt it on the issuing side, and then eventually like it took like 5-6 years for it to all come together. But then it was like super sticky.
Yeah. Well, Australia was the same. It was actually quite far ahead with chip and pin and contactless pay.
Yeah.
We had it in 2014. I first came to the US in 2021, and I was still have to give my card. They swipe it. I sign. That was 9 years behind.
Yeah.
In the US in terms of that technology.
But once it comes, it's like really sticky.
Yeah, but then now, it was Apple Pay that kind of broke the back of it here in the US.
Yeah.
And now nobody wants to go back. Everyone would just rather use Apple Pay for everything.
Yeah. Okay. And so what about so we mentioned like the private lending stuff. What about the RWAs? Who's issuing those like treasuries, or who's issuing those things? Is that you guys, or is that someone else issuing it on the Maple technology?
We it's a combination. So that one's a hybrid. So we work with a partner who takes a loan from the Maple platform. They pledge the treasuries as collateral, or money market funds as collateral.
Yeah.
And then they manage the purchase of the money market fund or the T-bills in a brokerage account, the off-ramping, because it's an extra, effectively, it's an operational burden. We like to keep at arm's length. We think they're a great partner. And we have a Maple entity that runs the pool. So the pool lends to them. They pledge T-bills as collateral. They go buy T-bills. They pay the interest back in.
Okay.
And we've got that down. We've actually refined that so much that we just did a payment yesterday in 2 hours. So somebody requested a redemption and they got the redemption in 2 hours, whereas before it was next day.
Okay.
So I would say we're getting pretty close to the the kind of the frontier of what's possible there in terms of speed. And the other important thing is the withdrawal. So before, you used to have to come and say, I want to withdraw in a couple of days, and then you come back a couple of days later and actually spend more gas to withdraw. Now you just say, I want to withdraw, and then as soon as the money comes in, bang, it goes straight to your wallet.
Oh, really?
Yeah. So we've we've been trying to refine the user experience and get that to pretty close to the efficient frontier. It's just a very competitive product now. So I think if you don't have stuff like that, your product is going to lag behind. Like I see, there's probably about a dozen competitors in that space now.
Okay, so we talked about some of like the futuristic vision of like what this could be, but like what are the real benefits of
doing this on chain?
Doing on chain now as compared to like, because I like we said about I need a loan to cover inventory, or like this fund needs a loan, but they like any of these use cases you could just source it from like a traditional lender? I mean, within reason, right? Depends on the use case.
Within reason, like you couldn't, you know, operating in a crypto business, you couldn't go to a bank. There's not many traditional credit funds who would give you a loan.
Not a bank, but there are some. Yeah, there are some maybe like more specialized players who could. But yeah, you're right. It's definitely more receptive.
Well, I think you'll find if you talk to a lot of those credit funds, they hate the crypto use case.
Yeah,
so most of them probably wouldn't.
Yeah.
Do a loan with.
But it's yeah. I mean, I wouldn't say there's no one, but it's more receptive.
Yeah.
With people.
So the answer is it's an access play to begin with. So I think at scale the cost savings become really apparent. So if I were to do Maple's business traditionally, I would have to set up a bank account. I have to set up a bank account in each country that I want to take money from our lenders into, and then each country I want to send the money to.
Okay, so it's international, cross-border.
Yep.
Borderless. Yeah.
Yeah, borderless. I mean, within reason. Like we're not lending money into the Congo.
Sanctioned countries.
Well, sanctioned countries, but also countries where there's a weaker rule of law. So if I'm going to do a $10 million loan to a trading fund, I'm happy if that trading fund is based in London, very strong financial center. I'm less happy if that fund is based in Uruguay. Yeah. Just tougher to get my money back if something goes wrong.
Fair enough. Yeah.
So at the smaller scale, it's access play. So most of these firms, like yourself, would have difficulty borrowing from conventional lenders, even from credit funds. So even funds who normally go further out in the risk curve, or they would get priced inappropriately, as in like way above what the true price that's reflective of the risk is. Yeah. And so that's our wedge, is find the firms who won't get served by banks because they're in crypto.
Cool, makes sense.
At scale though, running 1,000 loans at once, I would see significant cost savings. I don't have to like manually send wire details to somebody who wants to send us money. I just say, okay, go to the web app and then you put the money in. Doesn't actually require any intervention from us. Yeah. We just have to make sure they're whitelisted and have KYC'd them.
It's automated.
Yeah, it's automated. Yeah. And then when a borrower like Transact is paying interest, the smart contracts, so the code says, okay, well, this much interest goes to this person, this much interest goes to this person, this much interest goes to this person. Yeah. That's otherwise a pretty manual process. It's probably an analyst with an Excel spreadsheet in traditional finance. Yeah. And then when you actually have to send the money, that's another manually processed transaction. Like when you ever do, like ACHs and that kind of stuff, it's really painful. Yeah. And so for credit funds are generally doing a lot of that stuff manually. Yeah. And so what you see is that
you have to put in like your like reference code and like all and it's also
the fact that it's still often based on an address too is insane to me. Yeah. You have to put in the postal address of the person you're trying to send money to. Yeah. Sometimes numerous times we've had money go missing. So we will send it to an insurance broker who got a policy from us. This is actually a funny story because we've been trying to pay this invoice for 18 months. Yeah. And it bounces every time. And they're a company, they're actually a very large company. Yeah. And, we've tried probably a dozen times to kind of use conventional banking wires and it doesn't go through. If they had a, Ethereum or a Solana wallet address, we could have processed that in 15 seconds and it would have gone to them and they could have verified it. Like we would have been done 18 months ago and they would have got 18 months of interest on that payment.
I love the US and I'm very thankful for all the opportunities in the US, but like the payment system here is so dumb. It's like, and it's like all you have to do is just like move money from one place to the other and like not have fraud and like
that's partly why they talk about like there are other aspects to a CBDC, but one of the benefits of it is it's actually just really easy to manage a payment system. Yeah. Like it's a much easier way than what is conventionally used for a payment system to just use a blockchain and have all these wallet addresses. Yeah. So at scale we would see cost savings that would let us give a lower interest rate to the borrowers and a better payment rate, pass-through payment rate to our lenders. And so the goal is, can I eventually win customers off of, the Ares, the KKRs of the world by, because I think right now, a big pension fund cares whether its money is in crypto. But I think 5 years from now, if I can say, okay, well, I can just give you a higher interest rate on the money you lend to us than what a KKR can through private credit. I don't think they care. I think they'll say, okay, well, crypto's now been around for 20 years.
Yeah.
Hasn't yet, but in 5 years' time, I'm saying. And same for a borrower. I don't think a borrower cares if their money comes from crypto, provided you meet basic compliance requirements.
Yeah.
I think they just care about the lowest rate, fastest settlement, best experience.
Yeah. I mean, in this case, it's almost like more of a technology rather than like trying to reinvent.
Technology is always like unopinionated.
You're still doing the exact same thing with USD denominated currency, doing the exact same type of loans. It's just like, yeah. So like in theory, there's no reason why they should care. And that, okay. So we've got borderless access to all different kinds of people who maybe couldn't get traditional loans. We've got automation, and that kind of plays out really well at scale. And then another benefit, which is kind of like to do with the on-chain settlement, is like, for example, let's say you wanted to get like a revolving line of credit. Like let's say we wanted to get a revolving line of credit. You could settle that on the weekend, right?
Yeah,
there's no reason why not.
Well, and also you can settle it on a weekday after 5 p.m. or after 6 p.m. Whenever the wires normally stop.
Yeah.
So it's 24/7. We have settled loans on the weekend. We have settled loans at 11:30 at night on a Friday if a client wants it.
And that real time settlement is important because like that example you said of like you're trying to pay through a bank and the money is in flight for days. That's meaningful because that in-flight time of that money is costing you money because you could be doing something with that capital.
100%.
And
well, you think in your case, you talked about it being like it might be 3 days of float that you need. Well, it's typically T+3 settlement, so that window, is meaningful business for you. That's the difference between needing a loan and not needing one.
Yeah. I mean, it's very compelling, right? You're not like, you're not trying to like reinvent finance the way that maybe some of these like DeFi protocols are doing, but you're just doing the same thing that you were doing in your previous work experience at traditional lenders, but you've just like automated it. You've made it, and then also like if it's on chain, like that can be automated with other smart contract calls, right? So you can have these kind of like if else statements, like once this loan happens. So for example, like let's say we got a fixed line of credit, and a lot of the time we're not going to be using that, right? So if it's on chain, we can instantly like take that in and out of DeFi pools or even like your treasury products or something else that can earn yield on that. And so your lenders and your borrowers can have a lot of automations on their capital when it's not being used, or that can trigger when a loan is started or ended, right? Yeah,
for sure.
Which is like it's like the money Legos thing of Ethereum that like Joe Lubin from Consensus talks about. It's like money Legos, right?
Yeah. Funny story. I actually made a Substack called Money Legos, which I haven't contributed to in a while, but. That's exactly right. So you might have a firm that in the space of a week is sometimes lending and sometimes borrowing. When I say lending, I mean putting it into yield-bearing credit activity, like a savings account or like our T-bill pool. Because they might be operating on a deficit for the first 3 days of the week. So they got goods in, they need to pay for them, and so they borrow for that, and then on Wednesday, their big customer pays them, and then suddenly they're sitting on a surplus. They pay off the old debt, and then they actually have a profit, and they want to lend that for the next week. So you have it's always fluctuate. You're never 100% a debtor. Sorry, you're never 100% a debtor and never 100% a creditor. You're often fluctuating between the two.
Right.
And banks will often borrow money from them each other. Actually, like there's a huge market called the overnight interbank market. And that is banks just shifting cash between themselves because sometimes they have too much, sometimes they have not enough money. But I wanted to touch on something, which was, you mentioned, well, it seems like there are some valid use cases here. But I also think it highlights that technology doesn't advance by some committee going like, this is a valid use of it, and we approve it, which is sometimes, I think, how, you know, like the World Economic Forum would like it to work and how, you know, some of the regulators would like it to work now. But it shouldn't be that way. It should be very bottom up. We allow markets to dictate where capital is going to be allocated. Any technology should be presumed legal unless, you know, it is dictated otherwise.
Yeah.
It shouldn't be. And one of the problems I have with the crypto space is that we are presumed to be illegal until we are deemed legal by granting a law to say that you can, you know, you can use and operate and move around crypto.
Yeah.
I think, you know, the new Argentinian president gave a really good speech the other day where he highlighted, you know, like free markets are morally right, and this is the way that capital should be allocated, and society should allocate their finite resources.
Yeah.
Rather than the more kind of socialistic approach. And Argentina is the petri dish of how we saw the socialist approach play out, which I think is particularly with crypto is playing out in too many other countries where you have this kind of, okay, it's illegal until we pass a law and deem crypto to be legal.
Yeah.
But the thing is, you know, the reason we can do lending is because there are people who are underserved who will pay for the service of borrowing.
Yeah.
And until such time as every other lender services them, there's a viable market. I can offer a service and get paid enough to continue offering it.
Yeah. So it's like you have the theory of why this is compelling, but then you actually have the real traction, and that kind of really makes it concrete, and it makes it quite tangible, right?
Yeah, exactly. It's the same with, you know, when the automobile was invented, it was slow.
Yeah.
And you didn't have a committee that had to like adjudicate and say, well, until it's faster than a horse, nobody should be driving these things around the street.
But people still did.
You found people who it was useful for, and there was some novelty effect, and you know there were thousands of companies competing in the space, but the innovation happened bottom up. It wasn't a committee that said, we think this is pretty good. Let's designate and regulate an automaker, and only they will be licensed to do it, and then we'll have 3 automakers who are licensed to do this.
100%. Yeah. Cool. And then I think we kind of agreed that the private lending markets is somewhere in the like 1.5 to
1.5 trillion. Yeah.
In the trillions, right? And I think we also agreed that like the real world assets market, like the on-chain stuff, is somewhere in the like 2.5 billion range, right? So we're talking like we're talking about being like roughly 1,000x out of this market. So you've got a use case that's really compelling. You've got reasons why this is better than traditional finance, which you used to work in. So you know how it works, right? This is not like so you really know how it works. You really know that this is tangibly better, and there's no reason why what you're doing shouldn't be the entire market in the future, right? Like, why should anyone not do this?
Yeah, correct. I mean, that's what I think. So the reason the private credit market is growing, so it's 1.5 trillion.
I mean, I can't think of any reason why everyone shouldn't do things like this.
Yeah, I agree, but it's never. I don't know that we're going to end up taking out. It'd be fantastic if we took 100% of the market, but there'll still be a place for other products for different niches.
Yeah.
But the reason private credit is growing is because banking is getting worse.
Yeah.
So I don't mean bankers are doing banking worse, but I mean as a service, the main regulatory body. So and the main regulatory framework, which is Basel.
Yeah.
So every time they release a new Basel, it gets stricter. And where they're at the moment is it's much harder, so it's much more costly, and therefore you do less of it to lend to unrated, non-public companies.
Yeah.
And so that's the reason private credit grew. Sorry.
Yeah.
Is because banks were less able to do it, so they still had the need to lend to borrow, and so they just found other people to do it, and so the private credit market grew organically. There wasn't a committee that said, okay, now, you know, the total financial system shall allocate 1.5 trillion to this.
Yeah.
It was because companies couldn't borrow from banks if they weren't public and they didn't have an S&P rating.
Yeah.
And so that is an example of regulatory distortion where they distorted the private market, and that created this new asset class. But private credit doesn't own any technology, as in most of it's run out of Excel spreadsheets or basic SQL databases.
Yeah.
Much of finance is.
Yeah.
And so our idea is, well, if we have the tech stack built in, you know, we've built software that lets us say where all the interest payments are going to go, lets us calculate the interest on all our loans, lets us manage a loan portfolio of 1,000 loans if we want. Private credit companies don't have that. That's, as I said, Excel spreadsheets for them, or some very basic systems. Because they relied on banks to process all the payments. And so the thesis is, well, if you package payment processing, so sending money on the blockchain, with this software that you build in smart contracts, can you, as a vertically integrated lender, operate at a lower cost than Apollo, KKR, Ares, Blackstone? And I think the answer is yes. But we get, a few years to prove it out now. Like, if we can, in 5 years, be offering loans cheaper than they can and aggregating more capital than them, and give lenders more confidence in our systems because they don't own any technology, because they've relied on banks. So and here's the thing is if they consistently have to pay, if they still have to pay banks to send loans to their clients in 5 years' time, that's going to eat into their margins. And they're going to be reliant on banking technology. I think our technology will get better and better, cheaper and cheaper, and eventually it'll make a really significant difference in the costs we charge customers or the returns that we pass through to our institutional lenders, the pension funds, the insurance companies. And that's, so that's the 5-year thesis. And why wouldn't everyone do that? You saw, eventually Walmart became an omni-channel company, right? Initially they thought e-commerce was garbage. Then eventually late adopters, though they built a way that you can do, you can order something online, pick it up in store, have it delivered to you. So they became omni-channel. And, private credit is, singular channel at the moment. You get the money through a bank account. We are kind of multi-channel in that we could send the money out through a bank account, or we could send it in stable coins over the internet and have it arrive in 1 minute if you're on Ethereum, 15 seconds or 2 seconds if you're on Solana or one of the faster chains, and instantly arrives overseas. I could lend to a client in Japan for Blackstone that'd take 3 days.
Okay. And yeah, I mean that's compelling and it makes sense. So I think we talked about comparing it to like TradFi and how it's better than TradFi, and I think that makes total sense. I can't really find any holes in that logic. What about now comparing it to DeFi, right? Because some people are like, they're like DeFi purists. They're like no KYC, no trust, like trustlessness, full trustlessness on everyone. And this is not that, right? Like you guys are doing KYC and KYB on every single person and company who's involved in your ecosystem.
That's right.
It's permission system, and it's also not decentralized, right? And it's under collateralized. You know who's on the other end of it. So like how do you compare Maple to like an Aave or like a Compound or something like that, where it's like totally anonymous, fully collateralized? I mean, I think the answer is like probably a little obvious, but would be good to just hear your thought process on that.
It's a fundamentally different business model. And so there's a few differences. There's pros and cons. So you highlight some obvious differences. So there's permissioning. So that's permissionless, KYC-less. Totally automated, so you can't be declined for some reason. Whereas we could decline you as bad credit.
And you have to negotiate on like a case by case basis.
You have to negotiate on a rate. So those are I'll paint some of the differences and some of the advantages.
If I wanted to get a loan, I'd have to take like weeks or months to negotiate and sign a contract. And
I mean, with us, we did a loan the other day. We negotiated the entire thing and settled it today, and that entire process was 2 days, so 48 hours.
Okay, that's pretty good.
Which is pretty quick. Like we're gonna try and be quicker than a bank.
Okay.
But
it's still
we
not
won't be
like
that
clicking a button and
it's not like clicking a button and getting it, but you pay different costs. So the most obvious differences are permissioning. It's algorithmic, so they don't have like an expert decisioning stuff. So for a basic stuff, it's much better. Like if you want to post ETH and borrow stables, they'll probably get you a lower rate than we could. Companies find it difficult to use those though because they're worried about AML sanctions risk. So because it's permissionless, anyone could put money in, and so source of funds is an issue. So if I'm like a regulated financial institution, I might not be able to take a loan out because there's some risk that it might have come from illicit activity. I don't think, for the record, I don't think that's a large proportion of crypto, but that's a compliance issue that the bank can't get past. They can't do a source of funds, or not a bank, but a corporate borrower won't be able to get past in a lot of situations.
Yeah.
But also, you can't do a bespoke loan. So one of the advantages of using us is you have like an expert overlay. So you might have something that's a little bit less liquid as an asset. We did a loan with GBTC backing because we studied, well, how much GBTC, if we had to liquidate, could we move in a day?
Yeah.
The amount that we're going to hold as collateral is a pretty small proportion of that. So we'd feel pretty comfortable liquidating. So fine, we'll take it. But Aave, or Compound or one of those algorithmic ones can't do that.
Yeah.
Because they can only do a one-size-fits-all approach.
Right.
We can also be a little bit ahead on risks. So, Aave had the issue with the co-founder loan.
Yeah.
So that was something where you had a single borrower who was like 50% of the circulating supply of the token, pledged it all, took out huge loans.
Yeah.
And if he had not been able to pay it back and he was getting closer to a liquidation level, then you would have had an insolvency event on the platform.
Yeah.
And then you would have had the Aave token having had to be sold to to recoup that.
Yeah.
I think the ecosystem and Aave did a really good job of handling that. So you had risk analysts said this is problematic. They picked it up after the fact.
Yeah.
But they then changed the rules, and then some trading firms and investors came in and bought the tokens OTC off him, so that he could pay back part of his loan.
Yeah.
So I think that was like well handled, but that required expert intervention, right? Like that was not that was not the protocol functioning algorithmically successfully.
Right. And like, I mean, you can get those kind of liquidations in traditional finance. I mean, like George Soros famously shorted the pound, right? And he just kept like hammering them until like they had to start selling off stuff. But in the traditional finance space, you're having like the safety of like a lot more capital behind that, a lot bigger.
Unless you're Lehman Brothers. I mean,
well, yeah.
but I think it's each situation is a case by case basis. So in the GFC, you had the issue was everyone got insured, but they all got insured by the same party.
Yeah.
And then none of them took the time to tabulate. Well, if we all call on that party to pay out the insurance, is it going to be able to? And the answer was no. AIG couldn't pay everyone's insurance coverage. Yeah. But so those are some of the differences with DeFi. Where it's really good is if you have, one of the larger sort of cryptocurrencies, and you just want to put it in very quickly, get a loan, and get a one-size-fits-all interest rate.
Yeah.
And they're able to do that because they don't have to have staff doing credit analysis or any of that kind of thing, or customer service staff, onboarding staff. They don't have to do that, so they can operate at a lower cost margin and do those loans quicker. But you have to pay it up in other ways.
Yeah.
So if I looked at the lending, the permissionless lending ecosystem overall, there's a cost, and the cost is hacks and security issues. So you had like Euler had a hack.
Yeah.
There were a few others. There was early on there was like Fulcrum.
Yeah.
And so as an industry, if you said, okay, well now the industry needs to self-insure by paying premiums into an insurance fund that can cover if one of us gets hacked, then the true cost is probably much higher, and that should probably be passed on to their borrowers or to their lenders. Otherwise, it's disproportionately applied to somebody who gets affected by a hack.
Yeah.
As a borrower, your risk is also that you over collateralize your loan, but it gets hacked.
Yeah.
If you were over collateralizing in Maker during it was like Black Wednesday in March 2020, and the liquidation engine didn't work properly. So there was an insolvency event, and they had to sell Maker tokens to replenish the balance sheet. But that's the hidden cost of something doesn't work.
Yeah.
And you have no rights, so you potentially are kind of just out of luck there. Yeah. And so as an ecosystem, you pay the cost in if you don't pay it in one way, you pay it in a different way.
Yeah. And when we say hack, I mean, this can be like a hack in the traditional sense of like someone just getting access to your system and stealing your stuff. But it can also be like just a systematic risk and economics that are just not well tested, right? And when we're talking about the types of loans that you guys are doing, we're talking about like financial instruments that are traditional, that are just like normal financial instruments. And I don't think you guys are like even really competing because they just serve such different. At least for like
we don't try and serve like a retail market, and sort of the base case borrow on one of those would be the retail market. but yeah, there's just like there's more costs built in, but I guess there's also more downside protection. Some of those things we can't really never say never. Like it's theoretically possible that a hack could occur in some way, but you can't flash loan Maple. You can't go. You can't put money into a pool unless we whitelist you, and so you're not going to have Lazarus Group flash loan a Maple pool and take out a bunch of money.
Yeah.
But that could happen on one of the other lending protocols.
Yeah.
And so that's why the lending protocol takes less precautions there with whitelisting.
Yeah.
Because they don't want to pay for onboarding staff, and it's a different business model, but that leaves them open to that risk, and maybe you should be compensated with a premium or pay a premium as a borrower if that's a risk that you need to cover for.
Yeah.
Things should in aggregate, the market should price in these things in some way.
Right. So as a let's say I'm a lender and I want to get some return on my stablecoin or whatever.
Yeah.
Then Maple I can get a higher rate of return, and
yeah, you would get a higher rate of return on
but maybe
like a Maple pool.
Not quite as like automated and instant. I can't have like a smart contract that calls Maple, but I can have a smart contract that calls like Aave and lends money, right?
Yeah, no, you can have a smart contract that calls Maple. You just have to get onboarded though. We just have to KYC.
Once you're onboarded. Okay, so once you're in the system.
Yeah,
okay.
but on average, with our secured lending pool,
yeah,
you would get a higher rate than you would on like an Aave or a Compound on one of those platforms. Okay. You would get a lower rate. You would get a higher rate on one of those platforms than you would on our two-bill pool. But on our secured pool, we're generally pricing it a bit higher, so you get probably better compensation as a lender there.
Okay, and then but on the borrowing side, like my use case of where I want to borrow money to do inventory for my goods and services that I'm selling for my business or whatever, I couldn't do that on DeFi, right?
I think some of those DeFi platforms have looked at taking in RWAs like invoices, but most of them don't really have credit teams, so they're not really trying to serve that market. They're not building in credit expertise
and
into their
it's mostly for
tech
leverage.
Team.
People are using these products for leverage, right? On the borrowing side, they're borrowing something against something else and then doing that many times and leverage.
Retail does, but not every borrower. No, like in the example I gave before of a fund who came to us so they could delay a capital call. They could have borrowed from Aave.
Okay.
They won't because compliance. They don't want to take money from effectively a permissionless pool.
Yeah.
But it's the same use case. They pledged collateral to take out a loan, and the loan allowed them to defer a capital call for LPs, and that's going to be a use case for a lot of funds.
Yeah.
Or that they wanted to kind of do a deal, go into a venture deal in the meantime. But for an invoice company, we could do a loan to your company or to a similar company based on your invoices, for example.
Yeah.
And we can assess your creditworthiness and then price that loan appropriately. Those DeFi platforms can't do that.
Yeah. Okay. And then we were talking earlier about how like most of the lenders on your platform are like kind of crypto native people. They're like crypto native HMIs or foundations, right? So their onboarding journey, I guess they already have crypto, right? They already have crypto ready to go, and then they would have to either KYC with you or KYB with you. So unlike maybe like a pure DeFi play, you guys actually have like an ops team and you have people who are doing like KYC and KYB on them in a centralized way. Yeah, you're approving that, and then they're able to negotiate through a pool and get a loan basically, or to give a loan. Okay.
Yeah, exactly right. So they would come, they would come to us, they get onboarded, so they supply the documents, they go through KYC, KYB.
Yeah.
They'll sign a loan agreement, so it imposes legal obligations on them. So if they default, there is recourse. And then they'll provide their financials so we can due diligence them, and then we get through commercial negotiation, then they take down a loan.
Okay.
Yeah, that can be as short as 48 hours, or it can be as long as a few weeks.
Yeah. Okay. And then me, as someone who's running a fiat on-off ramp company, I'm curious about how that's going to play out in the future. So what kind of onboarding are you going to be doing for? What kind of onboarding are you going to be doing? Do you see in your mind in like 1 to 5 years? Like, are people? Do you see the future where people are just like all having stable coins ready to go, or do you see a future where you start to try to go out to like maybe more of a quote unquote mainstream like fiat native type
We-
people?
We are working with an on-ramp service, so we can do fiat as
Mhm,
well.
mhm.
But my view is that more people are going to be departing fiat and going into stablecoins
Yeah.
over time.
Yeah.
So
Like just natively, they'll just have stablecoins like ready to go.
yes,
Okay.
I'd like it. You know, I mean, if you think like anyone who's used PayPal, the original PayPal was really a stablecoin, right? Like they own your money.
Yeah.
They give you a token that you
Kind of, yeah.
that is represented on an app
Yeah,
for
yeah.
you, and then when you buy something with it, they redeem it, and then they send another firm dollars.
Yeah.
But the dollars were in a PayPal account. The dollars weren't in a Sammy or a Sid account.
Yeah. Yeah.
So that was kind of the original stablecoin. But my view is most people come from fiat into stablecoins
Yeah.
in the future because it's lower cost. So and I think it'll also be driven by businesses. So currently, if you're a business, you pay 2 to 3% for debit card processing.
Mm-hmm.
If stablecoins hit or drop below that,
Mm-hmm.
then a merchant will just accept stablecoins, I
Okay.
think. And because when you're paying with debit, like you're paying with your money, it just takes the merchant longer to get it, and they pay a fee on it. So if
Okay.
you just gave them the option, and you said, okay, well, you can have your money now, and you can not pay a 3% fee. Which product do you want? Like, I think
Yeah.
they'll vote with their feet.
Yeah.
And I've seen that now at some crypto conferences. Like when I was at the Solana one in end of October,
Yeah.
you could pay with USDC
Yeah.
at vending machines.
Yeah.
It was actually more expensive if you chose to pay with your debit card.
As it should be. Yeah.
Yeah,
'cause
because there's
so
more
much
cost
fees.
built in,
Yeah,
and
yeah.
and also, I mean, there's weird cost too because that's like a very monopolistic business. You know, you have
Yeah.
Visa and Mastercard, and they
Yeah.
are almost the entirety of the market.
Which is a super interesting discussion
Super
on its
super
own.
interesting.
Yeah.
But anyway, so my point is, I think people are going to vote with their feet. I think they'll go more to stablecoins. I
Yeah.
think vendors will accept more stablecoin payments. But for us, we
Yeah.
don't want to leave out fiat people, so we are working with an on-ramp provider on an off-ramp provider to offer that, and
Yeah.
that's your business as well.
Yeah. Yeah.
But that means we could deal with a borrower who says, okay, I don't care where my money comes from, but if you give me a competitive rate, I'll take out a loan from you.
Yeah.
And, we would then be able to have just fiat drop into their bank account. And then maybe for a family office, they want a good yield from what we're doing.
Yeah.
And, so that they're willing to lend money to one of our entity, to our SPV for secured lending.
Yeah.
And once a month, they'll just see, income drop into their bank account. Like maybe they don't want to manage a wallet or a stable coins. So
Yeah.
that's, I would do anything to deliver a better user experience.
Yeah. So it sounds like in the long run you're expecting that you won't even have to do on and off ramps. But
That's right.
in the kind of short to medium term, you're like, okay, there's still some people who just do
For a
that,
while, you
and-
had to
and why
send
leave them
fax.
out?
For a while, you had to send faxes,
Right.
and eventually you just send emails.
Right. Yeah. Yeah. I mean that makes a lot of sense to me. And then what about on the identity side, right? So right now you're doing quote unquote centralized identity checks, right?
Mhm.
So how do you see that playing out in the long run? Do you see some kind of like decentralized self-sovereign identity forming with like attestations, or do you think that you'll just keep doing KYC and KYB in the traditional way just because it makes more sense?
KYC, KYB is like a tax on business.
Yeah.
So it's if you look at like the amount of fraud and money laundering it prevents, it's not a ton. Like it's quite well documented that it probably costs something in the order of 30 to 100x what the value it generates.
Yeah.
But I think it's pretty interesting to have on-chain attestations that
Yeah.
KYC has been done. KYC or KYB has been done. I think Coinbase and Circle had both, piloted projects there. And if we could benefit from them by reducing our onboarding time, we would vote with our feet and use those.
Yeah.
Those guys will have really good KYC, KYB onboarding processes, and so
Right.
if they can provably show that a client, was onboarded by them, then I see a lot of value in us just saying, okay, well, we understand how their policy works, so maybe they give a reliance statement
Yeah.
or some kind of reliance right on their policy and allow you to audit it from time to time, and then we would give their clients value by saying, okay, well, you don't have to go through onboarding again.
Yeah.
I think it's quite dangerous that I probably have about 100 copies of my passport now with all these very poorly secured different services, right? You know, every startup, no matter how small that I want to get a service from,
They have a copy of your
they
stuff.
have a copy of my passport and my address, and it's probably just in a Google Drive somewhere that's not very well secured.
Yeah.
I think it would be better for
Hopefully
public
not, but
safety
it's
and
possible.
security
Yeah.
if we could just rely on a few large, entities that have KYC'd people. Like if I could get a token, or a soulbound NFT next to my wallet address that says, okay, well, Sid was KYC'd by Coinbase, and then other people could rely on that, then I no longer have to, have thousands of copies of my passport in, unencrypted Google Drives.
Yeah. Yeah. I mean, my stance on you is maybe a little different in that even though the cost of KYC is very high and maybe it doesn't stop that much bad stuff from happening. Like if you don't do KYC, my stance is that like a lot of bad stuff would really happen because like when there's opportunities, like there are like a lot of dark bad people in the shadows who kind of seize up and do stuff. And I think also
I'll put it this way.
Yeah.
What's the acceptable level of fraud?
Yeah.
And illicit money use that you want to get to?
Yeah.
Because KYC doesn't get us to zero.
It's never going to be zero, right?
And so you just set like what's the acceptable level to get to, and then what's the cost of getting to that level?
Yeah.
And you try and get the cost as low as possible. I would say at this point we're at like a very high level of cost for a very low level of good.
Yeah.
And the question is, can we drop that level of cost without having the level of fraud or illicit activity get much higher?
Yeah.
I've spoken to a few market makers who have experimented with comparing DeFi with traditional finance, and a lot of them estimate there's between 5 and 10% of exchange, like regulated exchange activity, is illicit.
Yeah.
You look at all the large, I won't name any names, but you look at all the large financial institutions who routinely every 2 to 3 years will cop like a multi-$100 million fine for enabling illicit activity.
Yeah.
And so it continues. There's just a fine imposed on it.
Right. I think that's maybe something that people don't get about anti-risk or anti-fraud is that like you don't stop it, you just minimize it, and it's kind of a it's like a trade-off.
It's an engineering problem.
It's a trade-off. Like how much friction and hoops am I going to make my user jump through, and then how much is that going to reduce fraud? Right. Yeah, I think that's fair enough. And yeah, I think that if we do have a system that allows decentralized identities or some kind of attestation in a way that like actually works and does the job, and hopefully like regulators will recognize that and yeah. So how far out do you think that is?
Tough to say. I mean, hopefully it's 2 to 5 years rather than 5 to 10.
Yeah.
Because as I said, there's a large annual cost borne by the financial system that's ultimately passed on to consumers.
Yeah.
Of conducting very expensive checks.
Yeah.
And one of the issues is the law might be in place, but the problem is that you ratchet up the cost of compliance.
Yeah.
So if you said, I run my own KYC, a lot of people say, well, that's crazy. Why don't you pay this exorbitant fee for somebody else to do it for you, just so that you can say that somebody else is doing it for you?
Yeah.
When the cost of compliance with something is so expensive that there is a cottage industry that's cropped up who offers that service, and they can be venture backed because the venture investors think that there is that much money in it, that's really problematic. That's a distortion of society's allocation of resources.
You think it's inefficient?
Yes. Yeah. Well, I mean, do you guys do your own KYC or do you outsource it?
Well, I mean, technically we are the ones who are doing the KYC.
No, I know everyone does it, but you pay a third-party provider to do it?
We use a ton of vendors.
Yeah.
And
right?
we have a risk stack that
So it shouldn't be that costly. What my view is, it shouldn't be that costly to look at someone's passport and say that that's them.
Yeah.
Right? Like if you think that's the underlying cost, but what you're actually paying for, Sammy, is the stamp of approval so that a bank will let you deal with them by saying, oh, well, like actually we just use this third-party provider that who's like venture-backed. Like that's what you're really paying for. You're not paying for the efficacy of the service.
So there's two parts.
Credentialism.
There's two parts to what we do. And this is maybe a longer discussion, but I'll just say briefly, which is that one, we do have to tick a box with regulators. We do have to say that we've done this, and we have policies that we have to adhere to. The second part is that if we didn't have like a really strong risk engine that was detecting signals from a lot of vendors and a lot of stuff that we built in-house, there would be a lot of really bad stuff that would happen. It would happen really fast, right? Like as soon as you have like weaknesses and gaps, you're going to pop up on a bunch of forums on the dark web. People are going to say like, hey, this platform, it's really easy to get money and launder money, really easy to do credit card fraud, and it's going to happen super fast. So it is a genuine need for us. And probably a lot of other people.
Yeah. Okay. Well, I'm not disputing that there is a genuine need for stuff. I think what I'm disputing is the credentialism.
Yeah.
Of like you have to pay a bunch of money to a third party.
Yeah.
So that a bank will deal with you.
Yeah.
Because they know the third party.
Yeah.
That's credentialism. I think it's an inefficient cost for most businesses to bear.
Yeah.
And I think for for basic startups that are not moving a ton of money,
yeah,
they should just be like the KYC law should be such that you can just comply with it yourself. You don't need a third-party provider for a ton of cost.
As long as you've kind of solved the problem, which is not allowing like a ridiculous amount of bad stuff to happen.
Yeah, but again, let's just what I'm talking about is like a 1 to 10 person startup.
Yeah,
that's like not moving billions of dollars of money.
Yeah.
Even they get pressure to like use a third party vendor, which I think is disproportionate. Like I think it's not proportionate to the the size of the business or the value of what they're transacting.
Yeah,
that's my case. I just think it's an overbought service.
I love that you had that opinion, by the way, because your business is like somewhat traditional as compared to a lot of crypto companies. But I love that at heart you're quite like a purist and you want to like decentralize things. That's really cool.
Yeah, well, not even decentralized. I just see bureaucratic rot in a lot of what happens in financial services, and I just think we should re-underwrite.
Yeah.
Are we getting value for money out of it? And I just think like you should always just be asking, are we getting value for money out of this?
Right.
I don't think we are.
And what about credit scoring? Like how does that? Because we're talking about identity now, right? And part of identity is like, is this person who they say they are? Are they like not a like sanctioned person or a PEP or something like that, right? Then there's the actual question of like credit scoring and risk scoring, right? Which is maybe not super relevant to the kinds of loans that you're doing now, but in the future could become super relevant. So how do you see that credit scoring thing playing out? And how do you imagine that you guys will be doing this in like 5 years?
Well, credit scoring is more pertinent to. There are credit scores. There's credit ratings for companies.
Yeah.
And those are really expensive to get because it's a very concentrated, very concentrated sector. So you have Moody's, Fitch, and S&P.
Yeah.
And they kind of do 90% of the ratings.
Yeah.
But in the retail sector, you have your FICO score from Experian.
Yeah.
And that's really important for retail lending. So we don't do as much of that. If we did do retail lending, which is requires a different set of licenses to do, and it's also a different business model. It's much more, it's much higher operating costs. You got to have a bunch of customer, call center people, ringing customers. Versus if I do one $10 million loan to an institution, that's like one relationship manager who's managing $10 million.
Yeah.
Whereas, if I did $10 million of consumer loans for, $10,000 to $50,000 each, I gotta have a lot of people on phones and a lot of customer service people.
Right.
But I think credit scoring, most of the activity that you would score is happening off chain at the moment. So the on-chain analytics is not really helping yet. I think over time, most of it will migrate on-chain, and so it'll become much more useful. Yeah. And then I think initially you'll have hybrid scores where it's like off-chain activity and on-chain activity. Then eventually you'll move more towards on-chain activity. At the moment, the biggest determinant of whether we would lend to somebody is their financials. So right. It's if we have collateral trumps everything. If we don't, or if we're doing less collateral, then we want to look at their financials, see how profitable they were. Maybe you use an audited set of financials from once a year, and that gives you, how did the business look as at the end of last year? And then month to month, you'd look at their management accounts and see how it's tracking.
Right.
So it doesn't fully prevent fraud, but, these are useful ways of mitigating
Yeah,
risk.
which is how, like, a kind of traditional way of how you'd assess
But I think
any loan.
what I would use, so I don't want, our business to be too reliant on paying for external credit scoring.
Yeah.
Like I think there's a place for it, but I think what you'll see is you'll see more providers who are offering like an AI driven credit score. Maybe you feed the financials into an AI model, and then it spits out, well, these things look kind of off. This is pretty unusual for the sector that they're in. You might want to dig into this question, or it spits out the questions that you should ask them, or it gives you a recommendation, like, because the goal is not necessarily hit 0 defaults. It's just to hit a manageable level of defaults that's below your interest rate and below the cost of running the business. And so what it could also do is it could say, this loan's a bit more risky. Like, we could still do it, but we have to price it a bit higher.
Yeah.
So I think the combination of AI with credit, with the data that you get on chain, because this is geeking out for anyone who's in the finance space, but the really old credit scores used to just factor in negative information. So it would be, Sammy missed his payment on a credit card, or he missed his utility bill, or he missed his rental payment. Utility bills were ranked lower than like missing a credit card payment or a loan payment, but it would only count the negatives, and they had to be reported by your other lenders to FICO, or Fair Isaac. With on-chain data, you can, and where it evolved more recently was they would count the positive payments. So it's like, okay, you made 3 payments, you missed 1, but we're actually going to give you credit for the 3 that you made. And on-chain data will count all, can just as easily count all the payments that you do make on loans, and how much money moves through wallets that you control.
Right.
So I think analytics is going to get much more granular. It's going to be much more high powered. There's going to be much more efficacy in using it. And everyone's going to be racing to develop these kind of, AI or algorithmic credit scores.
Yeah, which is kind of like what open banking was supposed to be.
Was supposed to be that,
but
it's still in a very
might happen
cumbersome, clunky ecosystem, right?
Yeah.
Because the bank systems aren't really good at talking to each other.
Yeah.
Also, the banking system is really high cost to maintain. JP Morgan, I think, on next year's budget is spending 16 or 17 billion on tech. Imagine every bank doing that, and then compare that to the cost of running like a blockchain. Much lower cost.
Yeah. And are there any other kinds of signals that you see coming on chain that maybe are a little bit more exotic? Like maybe if someone has used this type of app or this type of NFT in a certain way, then that affects them positively or negatively.
In the same way that Facebook and Google would use data, and you got to get you have to be careful around this, because now you're getting into people's right to privacy. But if there's a wallet that borrowed from you or wants to borrow from you, and then they also use these other 5 applications, and one of them is kind of associated with a lot of people who default on their loans, should you mark them down? It's a very real question. Like it's a legitimate question to ask, but then it raises the issues of should you be able to do that, or is that a violation of their privacy? Should you be able to see like what else they what other apps they've used? The answer is probably somewhere in the middle, which is, okay, you offer the service where, okay, you can get a lower interest rate and a higher loan if you show us, show the lender all the stuff that you've used with that address, and give them more data, so effectively they can price the risk better. And if you don't, then it's harder to price the risk of default, so maybe you pay a little bit more. But it might be a good trade-off for you if you want to preserve more privacy. But that's just letting the market decide then, which I think is more interesting. Like, you're not taking that right away from them. Fine, I can pay a higher premium to get more privacy, or I can give up more privacy to get a better rate or a larger loan. And I'm sure people will take each side of that.
So there's like a ton of data that's going to be on chain, and the mechanism of how that is shared with data privacy is interesting.
We the before starting Maples, that lending company I was at, they would it would scrape customers' data using Plaid when somebody wanted to apply. So the person would give them permission,
makes sense.
And you go in, scrape the bank account data for the last 90 days. But if you saw gambling sites, that would be a red flag. Like, that's somebody who's going to be less likely to pay your loan back. Like somebody who's sinking hundreds of dollars a week punting horse races is just, like, for obvious reasons, going to be a less reliable borrower.
And okay, so that's kind of data that you're pulling from their records. What about attestations? So I'm very interested in this idea of like a self-sovereign attestation, right?
Mhm.
Like I say, um, Sid is X, right?
Mhm.
Like Sid is good at tennis or something like that, right?
Yeah.
And then I sign that with my private key,
Mhm.
just plain old cryptography. You now hold that, so that's the self-sovereign part, right? You hold that, and you can reveal that if you want to, but you don't have to, right? So you have the signature. You encrypt that with your key, and then you can share that with someone. Let's say you want to join like a tennis group. You can say, hey,
Yeah.
I'm pretty good at tennis, right? So now let's take that in the context of like private credit, right? So do you see a future where people and companies are making attestations about each other, right? Because presumably, like, let's say I could get a signature from like Elon Musk and Vitalik and a whole bunch of people that said like, Transact is super trustworthy, great company, definitely not gonna have any problems with them. That, like, to me, if I was a lender, that would make me more encouraged to lend at like a better rate. So do you see a future where you could use attestations?
Well, I'll just ask. I think FTX would have got a ton of attestations
That's
in
a good point.
2022,
That's
right?
a really good point.
So
Yeah.
attestations from other people are not necessarily the best indicator that
Yeah.
somebody's a good borrower.
Especially if there's like a conflict of interest, right? Because
Yeah.
their investors were incentivized to pump them up.
Yeah,
Okay.
exactly.
That's a really good point.
So,
yeah.
Knowing that, I think it counts. There's some informational value to it, but you got to handicap it.
Yeah.
And I've actually seen some attempts to do this for like retail credit. So, if I wanted to borrow, might be able to get 5 of my friends to kind of attest.
Yeah.
Some of them can even underwrite me so that they have a financial consequence if I default. And this is kind of like social credit.
Yeah.
So the answer is it depends on the value, like how good is that person at telling
Yeah.
who is good credit or bad credit.
Yeah.
Like if you have somebody who says you're a good credit, but then they did it for 5 other people and they all defaulted, then that person should actually be like a penalty.
Yeah.
Like, because they're terrible.
Yeah.
At determining it. But I think it's valuable, and so looking at who gives the attestation. Are they generally a good credit themselves?
Yeah.
Are they a high income earner? It'd be unusual for like 5 or 10 high income earners to have like a deadbeat friend.
Yeah.
And then they all endorse him.
Right. It's not nothing.
It's not nothing, but it's not everything.
Yeah.
I would still want that company's financials or a look at that person's tax return or financial situation.
Yeah.
To kind of just to kind of assess them. But it does count.
And also, I guess there's also the argument that like as you make your credit scoring algorithm more complex, it's kind of like this Occam's razor thing where like maybe like the simpler thing is just better, right? Maybe like just like their postcode can tell you a lot more than like all this other stuff combined.
Two things on that part. So when I was in banking,
sorry, zip code for US people.
When I was in banking, the biggest factor in the S&P model is leverage, LVR on the house. That's the single biggest risk factor in whether a home loan defaults. The LVR on the house. So if the house is worth $1 million,
how much leverage
did I lend you 800,000 or 900,000? The more I lend you, the more risk of you defaulting.
Yeah.
Just because there's less buffer. So that's like some exorbitant. Think like 50% of the predictive power of the model.
Yeah.
And then for personal lending, it was, did the person own a home or not?
Yeah.
So somebody who owns a home is generally correlates with savings, conscientiousness, but also like if they default on the loan to you, then you're gonna go after them for their house or something. So generally, somebody's not going to default on a small loan for a vacuum cleaner.
Yeah,
and that was some of the goods in that purchase. So yes, you're right that actually most of the factors come down to kind of a few simple things, and it's not you don't have to have something horribly complex, but the really complex stuff gets you closer to the efficient frontier, but you find that most of it is a few just a few metrics make most of the difference.
Yeah, and like you say, it's complicated. Like some things might seem really good, but might be lies or misinformation.
Yeah.
Okay. Wow. That's do you see yourself integrating some of these kind of signals in the next 2 years, or like people on your platform, lenders on your platform? Do you see yourself like this, we're talking quite futuristic now, but is this something you actually
Yes.
can see yourself putting on the roadmap in the next 2 years?
Because
Wow.
that's all moat and alpha for us in terms of lending. So, we get outsized performance if we're able to better select borrowers who are, overpriced, as in they're paying too high an interest rate relative to their risk of default, and also reject ones who are paying too low an interest rate for their risk of default.
Yeah.
So
and that's, I mean, we talked about like the efficiencies of like settlement and all of those kind of things earlier on. This could actually be even like as compelling, or maybe even more compelling, if you can really drastically, like make a much better creditworthiness assessment of the that's super interesting.
100%.
Yeah.
That's good. I think we're kind of coming up towards the end, but I would say in terms of what I see coming for the future. So I think, as I've expressed earlier, I think that most finance is going to move on chain because it's just kind of the digitization of it, and also putting it into a shared database, if you will. That's really what the blockchain is everyone being able to kind of read the state of the financial system. But it takes time to get there. So we're still at the early innings. I think it would be premature to say most people are going to be using stablecoins in the next 1 to 2 years. But I think in the next 5 years, next 10 years, for sure, most people do most of their transacting with stablecoins. And that's when I think you'll see, lending in capital markets, but private credit is going to, a lot of that private credit is going to be happening on chain. The last cycle, that was about 55 billion outstanding. Now I would say we're less than 5 billion. So got a long way to go just to catch up to where we were last cycle. And as we know, every new cycle is bigger than the previous one.
Yeah. I mean, super interested to see how that plays out. And this has just been an absolutely fascinating bunch of information covering like so many. It's amazing how many different areas your company pulls together. So thanks so much for this fascinating conversation. And
no, it was my pleasure. Thanks for having me.